On a recent Dave Ramsey show, he trumpeted some rather outstanding investment returns in his personal investment portfolio over the last 30 years. Take a listen to what he had to say.
And over the last 30 years, my little portfolio of that has averaged over 12, most years over 13%.
Wow, Dave, that's great.
But I mean, it's not really hard to beat the S&P. The S&P is the average of the market.
Mm-hmm.
Okay, so here's the claim. Dave Ramsey beat the S&P 500 over the last 30 years and has averaged 12% and even 13% in some years. Furthermore, it's not such a big deal because it's easy to beat the S&P 500. After all, it's just the average of the 500 largest companies in the country. He seems to be saying that if your own personal investment returns are keeping up with the S&P 500, that's just an average outcome. In fact, if you were to get a grade on your investment performance, you might only earn a C. To get an A, you must far outstrip what the S&P 500 has done over time, and that appears to be what Dave Ramsey has in fact done. First of all, why am I once again calling Dave Ramsey out on the things he says on his financial show? Because some of his claims are so absurd and so outlandish as to cast doubt on just about everything else the guy says. If Dave Ramsey is willing to play fast and loose with the facts when it comes to the ease with which one can outpace the S&P 500 over time, then how much can we trust his claims about, for example, sustainable withdrawal rates in retirement, or the speed with which you should pay off your house, or his critiques of cash value life insurance or annuities? Okay, let's take a look at the cold hard data to see how Dave's claim stands up. The latest Standard & Poor's indexing study shows that in 2021, 85% of active fund managers underperformed the S&P 500. In fact, active fund managers are literally hemorrhaging market share to their passive index competitors. Over the past 10 years, 83% of active fund managers lost to the S&P 500 benchmark, and over the last 20 years, an astounding 94% fell short. Furthermore, 92% and 93% could not beat the S&P Mid-Cap 400 or the S&P Small Cap 600, respectively, over that same 20-year time frame. As a result of all this underperformance, it isn't surprising to see a growing number of mutual funds disappear altogether. Over the past 20 years, in fact, almost 70% of all U.S. domestic equity funds were either merged or liquidated altogether. In fact, as much as 60% of all existing mutual fund assets consist of, you guessed it, index funds. So how do we rate Dave's claim that he outperformed the S&P 500 over the last 20 years? Well, either this is the whopper of all whoppers, or he counts himself among the top 5% of all money managers in the country, even as he manages his own burgeoning media empire. That's quite the feat. Furthermore, what does he mean when he says he averages 12% per year and even 13% some years? This is either his average annual compound return in all years, or it isn't. You can't say that I average 12% some years and even 13% in other years. Is this another case of Dave playing fast and loose with the facts? Now, is all this to say that you should just park all your money in index funds over at Vanguard and call it a day? Probably not. Here's why. A study by none other than Vanguard themselves showed that enlisting the services of a qualified advisor can add as much as 3% to your returns over time. How do good financial advisors do this? Primarily by helping you stick to your investment objectives. Most investors make investment decisions based on emotion. We're supposed to buy low and sell high, but most investors actually do the opposite. Fueled by emotion, they buy high and they sell low. Financial advisors can hold your hand through jittery periods in the market so that you maximize your returns over time. So in short, it's not as easy to beat the S&P 500 as Dave Ramsey claims. It's even harder to beat the S&P 500 if you don't have a qualified advisor shepherding you through the accumulation phase and ultimately your distribution phase. In short, good financial advisors will more than offset whatever fees they charge you in the form of enhanced returns that stem from sticking to your investment goals. In conclusion, let me leave you with 3 takeaways. First, take everything Dave Ramsey says with a grain of salt. His entire shtick is built around making investments seem easier than it really is. Why? If he can make it seem like an easy, profitable, no-brainer proposition, he's more likely to get his debt-ridden neophyte listeners to move off of square one and start investing. If you can get 12 to 13% returns and then take 8% withdrawal rates in retirement, then even a small amount of investing will yield huge results down the road. Just remember, successful investing is not nearly as easy as Ramsey makes it out to be. Second, beating the S&P 500 over time is not easy to do. In fact, most active fund managers fail to do it over time. This is precisely why most fund managers these days are simply adding index funds to their overall portfolios. And if Dave Ramsey is wrong about this claim, what else is he wrong about? Lastly, it's not enough to just find a smattering of index funds, pour your money in, and then call it a day. A qualified financial advisor will help you yield much higher returns net of fees over time. They'll hold your feet to the fire through the vicissitudes of the stock market and increase the likelihood that your retirement savings will last through life expectancy. Furthermore, they'll help you situate your assets so that you maximize your after-tax spendable cash flow in retirement. Remember, it doesn't matter how much money you have, it only matters how much you actually get to spend after tax. If you would like some help implementing a balanced, comprehensive approach to tax-free retirement that shields you from the impact of higher taxes, head on over to davemcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the Power Zero network that has been trained, vetted, and qualified personally by me. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free video series. And if you have any comments or questions, feel free to drop them into the comment section below. I'll respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.